let me very briefly introduce you. We have, and make us smile so that everybody knows who you are. It's easy, except for Orit Azoulay. You are the only woman, so I'm happy to say Orit Azoulay is Global Head of Green and Sustainable Finance at Natixis CIB. We have Guillaume Boucher, Investment Director at ZenCap AM. We also have Thierry Laquitaine, Director and Head of SRI from AEW. Vincent Lemaitre, Head of ESG for Private Debt, Ticket Capital. Marc-Étienne Sébir, Partner, Global Co-Head of the Banking and Finance Group at CMS, Francis Lefebvre. And we're delighted to have Thomas Girard, Global Head of Green and Sustainable Syndicate at Natixis CIB, who will actually be moderating the panel. The floor is yours, Thomas. And just to remind you, obviously, you will have maybe a couple of minutes, hopefully, of course, Thomas, to have Q&A at the end. Thank you very much. Enjoy.
Thank you, Christina. Hello, everybody. I'm delighted to be with you today, and thank you to our panelists to come and join us today. So let's start. ESG, as you know, moves mainstream from equity to debt. Sustainable investment strategies are deployed in every financial market segment, including private markets. Sustainable finance is gaining traction in the form of loans, bonds, and securitization. In Europe, for instance, a quarter of total loans signed in 2021 were in label green or sustainability-linked format. Global issuance volumes keep growing as well. At mid-June, we count more than 650 billion USD equivalent issuances and a total of outstanding market at circa 4.5 trillion USD equivalent. So reality check, green is not a niche market anymore and actually can maybe protect against inflation, as mentioned this morning by Patrick and Niels. So what are our client needs? On the borrower issuer side, we observe willingness to support the achievement of the United Nations Sustainable Development Goals, but also to contribute, and I would say in particular, to climate action by reducing carbon emissions. And what we observe as well is CSR, corporate social responsibility, translation into funding strategies as a way of communication. On the investor side, there is a critical need for ESG data to comply with increased disclosure requirement, especially on climate. We will address this topic. And a great demand for green assets to decarbonize portfolio and reach carbon neutrality. Last, there is a need to evaluate and control the temperature of portfolios to deliver on net zero targets. So what are the challenges for investors, and especially for private debt investors? First, availability of ESG data, which are posing a major problem for non-listed securities, alternative and real assets. Also, many financial institutions have net zero targets, but very few know how to deliver. And I would say last, because this is very in the press at the moment, there is a growing concern on the risk of greenwashing that need to be tackled in order to ensure the credibility of sustainable investing markets, green and sustainable finance. So last, as an introductory remark, as a bank, Natixis commits to responsible finance with the ambition to be our client go-to financial partner for energy transition. This has been mentioned by Nicolas this morning, and this is deeply in our DNA as a bank. In that respect, we are hosting this roundtable today to inform you on the evolving regulatory ESG environment and green market practices, but also to introduce to you Natixis CIB Green Originate to Distribute strategy. So I would like first to leave the floor to our guest lawman, Marc-Étienne Sébir from CMS Francis Lefebvre, with the challenge, because we are 5 speakers in 45 minutes, to give you in 10 minutes a broad overview of the EU ESG regulatory landscape and its implication for private debt investors. Marc-Étienne.
Thank you. In the context of the Paris Agreement and the EU Commission Action Plan on Financing Sustainable Growth through 2018, ESG is coming to town for banks, funds, and corporates. And Thomas has very kindly asked me to summarize in 8 minutes all applicable regulations. Thank you, Thomas. So let's start with credit institutions. So in 2019, there was a requirement that was included in the capital requirements regulation for large credit institutions with securities listed on a regulated market to disclose prudential information on ESG risks. And in January of this year, the European Banking Authority has published its implementing technical standards, including the obligation to publish KPIs such as the green asset ratio or the banking book taxonomy alignment ratio, so imposing ESG disclosures obligations on credit institutions. Switching to funds, four main texts, SFDR, taxonomy, Article 29 of the Energy Climate Law in France, and amendments to various EU regulations. So let's start with the main one, Sustainable Finance Disclosure Regulation. So SFDR is applicable to some financial market participants and financial advisors, including alternative investment fund and UCITS management companies, credit institutions providing portfolio management, and some others. And what SFDR does is that it creates a framework for investors to disclose how they integrate and manage sustainability factors, both at entity level, so for the manager, and at the product level for the fund. Level 1 SFDR obligations came into force in March 2021. This covered all entity-level obligations, and for products, it covered pre-contractual and website disclosures. Level 2 requirements are expected to apply from January 2023. So let's see these two levels, entity level and product level. At the entity level, all requirements, or level 1, were applicable since 2021. There are sustainability risk policies, so financial market participants shall publish on their website information about their policies on the integration of sustainability risks in their investment decision-making process. On the 30th of June 2021, large financial market participants had to report annually on their principal adverse impacts. And in terms of remuneration policies, financial market participants shall include information on the website on how the remuneration policy is consistent with sustainability risks. Moving to the product level, there are three types of disclosure: pre-contractual disclosure, periodic reporting, and website disclosure. On March 2021, level 1, so it was high-level principles for pre-contractual disclosure and website disclosure. High-level principles for periodic reporting kicked out on January 2022. On January 2022, that's also when taxonomy disclosure kicks in, depending on the type of fund. So you have Article 6 funds that have no sustainability characteristics. You have Article 8 funds that promote environmental or social characteristics. And then you have the greener ones, Article 9 funds, that have a sustainable investment objective. So for Article 6 funds, disclosure is in the form of a statement to be included in the prospectus and periodic reports, saying that the product is not taxonomy aligned. For Article 8 and Article 9 funds, pre-contractual and periodic reports must explain the extent of their taxonomy alignment, and that has to be quantitative. So you need to include a percentage of your alignment with the taxonomy. Now in the future, on the 1st January 2023, all level 2 SFDR obligations will come into force. So more information will need to be provided depending on the classification. So obviously you have more extensive disclosure obligations for Article 8 and Article 9 funds. Let's see the 3 points. So in terms of pre-contractual disclosure, all funds will have to assess the likely impacts of sustainability risks on the returns of the product. And Article 8 and Article 9 funds must make additional disclosure using a mandatory template that is provided by the regulatory technical standards. In terms of periodic reporting, Article 8 and Article 9 products must periodically report on how ESG characteristics have been met, again, using the mandatory templates provided by the RTS. And in terms of website disclosure, Article 8 and Article 9 products must provide detailed website disclosures using, again, a mandatory template provided in the RTS. Now, Article 29 of the Energy Climate Law. SFDR, with a big push from France, allowed member states to have additional requirements. That's the option we've taken in France. So Article 9 of the Energy Climate Law not only transpose SFDR, but put some more obligation on funds on how they provide their clients and public with information, how they tackle ESG criteria. There are also amendments to various EU regulations to incorporate sustainability factors, and that will impact the governance, not only the products, because SFDR is mostly a disclosure point, but these amendments are not. So UCITS, IFMD, IDD, the Insurance Distribution Directive, Solvency II, the Insurance Capital Requirement, and MiFID, Market in Financial Instrument Directive, will all be amended to incorporate sustainability factors. This will all kick in August 2022, except for MiFID, where there are points that will be just in November 22. And finally, for corporates, so as an investor, you have to make disclosure on your investments, and for that you need data by your investments. In the world of corporates, you have currently the Non-Financial Reporting Directive that is going to be replaced by the Corporate Sustainability Reporting Directive, CSDR. They love acronyms. And you also have the Corporate Sustainability Due Diligence Directive that will also coming in a few years, but not now. That's it for the law.
Thank you, Marc-Etienne. I think that we all agree that regulation is fascinating, but unfortunately we don't have too much time to go deeper. So what I would like you to bear in mind is that there is so many regulations that need to be applied from an ESG standpoint, and this is clearly at stake because if I look at figures provided by Morningstar, over than 50% of the asset under management in Europe, fund commercialized, are already classified under Article 8 or 9. So it's really at stake for investors and also for private debt investors. Maybe a last question to you, just to transition to the next phase of the panel. What is to you, Marc-Etienne, the biggest challenge to implement SFDR?
In addition to the regulation, it's the availability of data, of course. As I said, you have to disclose. To disclose, you need data from your investments, so it's an issue. And in terms of regulation, I won't say call your lawyer, but call your ESG specialist within your entity. And if you don't have an ESG specialist, do call your lawyer.
Thank you for this nice transition. So I would like now to give voice to investors, and I will say with the same timing challenge to respect. So since March 2021, the EU SFDR regulation has required investors to disclose on ESG at entity at product level, and in particular to classify their fund under Article 6, 8 or 9, as mentioned by Marc-Etienne. So I would like you to ask you which classification have you opted for your funds and what impact SFDR had on your investment strategies. So we will start maybe with you, Vincent. So Tikehau Capital has developed an ESG by design approach, including a sustainability team investing pillar, if I'm correct. As head of ESG for private debt, can you tell us about SFDR classification? You have opted for your private debt fund, and what have been and are maybe your main challenges related to classification? And last, I would also be kind to hear about your corporate impact lending fund.
Okay, thank you, Thomas, and good morning, everybody. So at the private debt level, we have roughly 12 billion of asset manager at the end of last year. And I will say that 69% of our asset manager falls under Article 8 classification. 23% comes under Article 6 classification. and 3% under Article 9 classification. So under Article 9, we have basically our impact funds, and we have a mandate from a Dutch pension fund. Just to give you a bit of background, what we call actually Article 8, what means Article 8 at TKO, it is the funds as those we have been implementing what we call ESG investing. So it's different from impact investing. It is what we call ESG investing. So ESG investing for us is obviously enhance negative screenings, implementation of extra financial component within our decision-making process, and also we engage to disclose some extra financial information during our quarterly reportings. And we get the information from, we do what we call an annual ESG questionnaire. So we gather a couple of data points, and also we perform a carbon footprint. This is something we also track. It's important to mention that TKO, most of our clients are non-listed companies and at the private debt level, and they are SMEs. Go back to your second question, which is this one a challenge. Market Chain say, call your ESG specialist if you have any question about regulation. I'm an ESG specialist. I mean, at least this is my job at TKO. And I have to say that I call lawyers and regulators all the time, because to me, needless to say that this regulation, SFDR and the European taxonomy are very complicated. And if I have to keep only 4 challenges, I would say the first one is to understand the regulation. So there were a lot of questions about what should we do with our Article 8 funds, with the possible adverse impact, for example, disclosure. Should I include them or not? What are the consequences of not doing it? About the legacy of funds. How should I classify my funds if the period of investment is over or the fundraising period is over? And also, I feel like no one was speaking the same language across different industries. So regulators were speaking differently from investors, and even our lawyers were very different from one to another. So it was very hard to align the language. That was the first challenge. The second challenge is, as Market Chain mentioned, is data collection. Because as he explained, you need to calculate and not estimate, especially for Article 9 fund, the percentage of your portfolio that will be aligned to the European taxonomy. And also, you need also to calculate or try at least to come up with a number of what will be your investment aligned to the sustainable investment definition, the meaning of SFDR, which is a very challenging thing to do, because especially on non-listed company, we don't have a lot of data, and it's almost impossible to estimate what will be your scope of data and the quality of them. The third challenge is to put the knowledge, to get the knowledge, bring the knowledge to the teams internally, because these regulations are game changer. So it's going to change the way we interact with our investors, the way we interact with our portfolio companies. So it impacts sales across to compliance departments, and we need to make sure that everyone has a sufficient understanding to be able to discuss with their day-to-day interlocutors and avoid also greenwashing, because from time to time you can use some words that you should not, because you do not respect the meaning under the regulation. For example, impact, sustainability, ESG, etc. And the last one, but not least, is manage our investor expectations, especially when it comes to Article 9. We have been seeing a lot of investors that wanted to issue Article 9 funds, and from time to time I feel that the regulation has not been understood, because SFDR is not a label classification. It's not a label regulation. It's a regulation that will improve transparency. And there is confusion about that. And some of our investors, and I don't blame them because it's very complicated, I guess they do not understand what it comes with an Article 9 fund, for example. The scope of deployment is different, and the reporting requirements are very high. And especially on SMEs, on unlisted, you cannot guarantee that you will be in the position to favor their willingness. And on the last question about our impact approach, so it's a combination of a positive impact. So we work through the product and services of the company, okay, to try to find an angle to see how we can make a company impactful. And a combination of transition through ESG ratchets. So it's really to work on how I can help the companies to find a positive impact through its product and services. For example, if you're a healthcare company, we have a lot of healthcare companies in our portfolios. We try to address medical disease. This is something we're going to do. But at the same time, we're going to work on the company on ESG performance, meaning that we're going to work on, depending on what they have to address, but we can work on carbon footprint, reduce its emissions. We can work on diversity. We can work on waste. We can work on equipment. We can work on twinning. Okay, so it's two things for us: impact, positive impact of the products and services, and transition at the operational level.
Great, thank you very much. Thierry, at AEW, you have set up 4 sustainability objectives. One of them be it identify and mitigate physical and transition risk at properties and portfolios. You have also classified under Article 8 SFDR a compartment of your pan-European debt fund, the Senior European Loan Fund, SELF 3, correct? So what are to you the main challenges to classify your fund as head of SRI? And can you tell us maybe what are the main challenges, not only for AW, but for real estate debt investors with regard to the classification?
I won't be very original. It's the same thing for us. The first problem is the lack of clarity of the regulation, because there are a lot of words that are used with no definition. For example, what they call the DNSH, do no significant harm. That's why we have no Article 9, either on the debt activity or on the real estate activity, because it's a legal uncertainty, and we don't want to classify Article 8 in 2022 and to be obliged to declassify in 2023. So a lack of clarity. And even with the different publication of the European Commission and the different Q&A, we still have some dark side of this regulation. And we also have discussion with AMS in France and also the Supervision Authority in Luxembourg and Germany. And they are in the same position. They don't have all the answers, so a lack of clarity. I would say also a problem with the data, because it's more difficult to have ESG data on the debt activity, because we don't have direct management of the asset. So we need to rely on the sponsor equity to have the information, and it doesn't obligatory have the same approach and the same view on ESG as ours. So it can be a difficulty to collect information. And I would say that the debt activity is more complex, because as we are not directly managing the asset, we don't have the operational control as we have in real estate. We have a long-term experience in ESG at AW in real estate, but in debt activity it's more difficult, it's more complex, and to collect information to improve the ESG performance, it's more challenging. I would say also that the problem of training the investment team to have the same, at least a minimum knowledge about ESG, which is not a traditional component of the business. It's also a challenge, and to adapt our different processes to the ESG integration.
Thank you, Thierry. Guillaume, since 2020, all private debt investment at ZenCap Asset Management follow an ESG approach with a systemic ESG due diligence. But beyond ESG integration, you also put the emphasis on impact research and thematic investment. In March 2022, you have launched a new infrastructure debt fund, ZenCap Euro Sustainable Transition 2, ZEST. You have been classifying it under Article 9. So as an investor director and you're in charge of the infrastructure private debt fund at at ZenCap. Would you be kind to present the rationale for such a classification, and maybe by comparison to indicate why your other infrastructure debt fund have been classified not under Article 9 but under Article 8, please?
Thank you, Thomas. Good morning, everybody. Yeah, I think the first point was how do we attract new LP for our fund, and definitely Article 9 is a good selling point. Having said that, you have a real strong constraints regarding regulation. I think Marc-Etienne mentioned that very clearly. So when we consider this new fund focusing on sustainability transition, including energy transition, it was much more easier to consider an Article 9 when you want to define a sustainability objective for the fund and when you want to define KPI. However, it is complex. We call our lawyer. It was not enough. We hire also advisors to help us to define this ESG strategy and SFDR strategy, how we tackle that, how we define relevant KPI. Greenwashing you mentioned is also a really important point. So we need to define proper KPI considering the strategy. So in fact, it took a lot of time internally and with our advisors to go that. But at the end of the day, I think the asset class was, I think most to reach the constraints of the Article 9. Of course, it's not the case if you consider SME financing fund with a multi-strategy. So I think that was one of the key points when we consider Article 9 for this fund, which is of course a real concern for us. And to answer your second question regarding our previous fund, I think we made a first step with labeling our previous fund, Greenfin. I think, like Vincent said, it's not at all the same thing, but that was the first step also for us and vis-à-vis our LP, to move for that and to also, I would say, have a more dedicated and dedicated ESG strategy and analysis. But when you got already invested fund, you don't have the same constraints. I agree also with Thierry. He said that being as a lender is not exactly the same. You don't have the same access to the management. For this new fund, being Article 9 was also coherent with our risk position, being a junior mezz lender, and we do have much more easier access to the management and to data at the end of the day. But once again, even if you got access to that, I would say that data is an issue, definitely. But being closer to the management is easier when you want to have access to the data on the asset or on the company to fill in the ESG questionnaire. Sometimes it's the CEO. We face that push on that to help. So. Yeah, I think it depends really also on the asset class.
Thank you. So obviously ESG is not an asset. I'm very often listening to people non very accultured to ESG mentioning ESG assets. ESG is just a way to analyze things, and which is good. And this is what I bear in mind at this stage of the evolution of the market: is that ESG is not only a risk approach, and it's also an opportunity. And what I can hear from you is that ESG is good also to market your funds, to do some business. But today, definitely, ESG is a matter of disclosure. But not only from an ESG standpoint, and there is a clear focus on climate change. And throughout, I would say, the SFDR regulation, your funds, Article 8 and 9, also have to report on their alignment with the EU taxonomy so far on climate change mitigation and adaptation. So Thierry, at AW, you have taken several commitments to achieve net zero by 2050. For scope 1 and 2 on carbon emission for your real property asset investment. How do you deploy your net zero strategy within your private debt investment? And I will mention maybe the Europe senior debt strategy.
Just a precision, we didn't take commitment to net zero in Europe. It's the case in the States.
Okay.
It's quite complicated to take net zero commitments. when you see that there's so many definitions of net zero. For the moment, there's not a common definition of net zero. We are doing a daily work to reduce the energy consumption of our assets and to, when it's relevant, to equip with renewable energy. But regarding the debt strategy, I would say it's even more challenging to achieve a net zero on your building. But what we're working on is to encourage our sponsor equity to reduce the energy consumption by demanding, with the ESG grid that we developed, to ask him the energy consumption and the EPC, which is also a regulatory obligation in the taxonomy, and to encourage him to have a responsible approach in his daily business, with regular discussion on ESG topic with the sponsor equity. But it's, as I said, it's quite more difficult for the debt activity compared to the real estate activity.
Thank you, Thierry. Maybe a few words. Time is flying, and I want to leave time to Orit. But Guillaume, at Gap, how do you deploy your net zero strategy to?
Yeah, I think I will focus on our climate strategy because I do have the same comments regarding net zero. We do have an exclusion policy regarding coal, regarding unconventional oil and gas, regarding weapon also. We did on each transaction. We do on each transaction a strong ESG due diligence, including the climate part of this due diligence. We try to fix ESG objective on each investment on a case-by-case basis, of course, and including carbon emission and taxonomy alignment. And finally, we got a reporting, and then I will reporting regarding the carbon emission also. Once again, I think point which is very important is having access to the data at the end of the day. And once again, being in the infra and energy transition, it's easier to have access to this data when you got a defined asset and you can really have a proper definition of the electricity production, for example, or things like that. It's easier when you compare to other asset class.
Thank you, Guillaume. Last, same question to you, Vincent, before handing over to Orit.
Oh yeah, it's similar to my colleagues. As Thierry mentioned, there is no alignment methodology for the private debt as of today, which is a shame. But I've been told it's going to come up this year, at least under SBTi. So we committed, so for our net zero, we committed through our other asset classes, so private equity, capital market, and real estate, with the science-based initiatives, because there is a methodology. And we are currently investigating some other methodology for our private debt. For example, there is this net zero impact framework that came up recently, and they have a methodology where you can use the percentage reduction of your weighted average carbon intensity, what we call the WACI. So this is not adaptable as of today for the private debt, but we are looking at that. Yeah, and we are also looking at the, because when we talk about net zero, we also need to talk about residual emissions. So we are also looking at what we're going to do with our residual emissions, because obviously we want them to be permanently stored, and not temporarily. And this is another challenge. So we are definitely looking at these two things: the net framework, investing framework, and how we're going to deal with our residual emission.
Thank you, Vincent. So we've got 6 minutes. So Orit, how can we accompany our clients, especially private debt investors, with this crucial need of ESG data, especially climate-centric one, and what can we provide in terms of, let's say, green O2D value proposition?
Hi, everyone. Just a first word on us as a CIB vis-à-vis the regulation. We are also exposed directly and indirectly, and everything we've heard today on SFDR, even though a CIB per se is not regulated by SFDR, all of our clients are from an investor side, meaning that when we originate assets and you know, private debt assets to focus on our topic today, we have now I would say a commercial challenge to overcome, which is being able to qualify the environmental and social performance of our assets, and to provide investors with the relevant data sets they're looking for. But we're also directly regulated, so we also need to understand the taxonomy alignment, not necessarily for us as a CIB, but for BPCE Group as an entity, who will be, as part of our own regulatory duties, expected to produce a green asset ratio as per for example, as per the taxonomy. But I'm not going to list all of the regulations that we're directly impacted by, but there are a number. They're not only disclosure-based, if you consider the climate stress test that we've started to do under the supervision of the ECB. So having said all of that, regulation is not meant to drive business. So the idea here is to try and make it an asset, and to try and really develop a business case for it. At Natixis CIB, if I focus on the topic of climate, we as a bank, as Thomas mentioned, have developed a dedicated front team to develop sustainable finance, which is the team Thomas and I are running. But we also have committed and developed the relevant tools to steer our own transition. And if there is one thing which is absolutely certain after a few years or a few quarters of monitoring of our impact, our transition is going to come from that of our clients. And that is the most efficient way to actually decarbonize our activities. So what we've done is to develop a tool which is called the green weighting factor, and I'm not going to go in much detail in 3 minutes, but just for you to know what we're talking about, it's a tool which was designed before any of those regulations we are mentioning, and it was designed not for reporting nor disclosure purposes, but for business steering. So it's a pre-credit decision tool that is a mandatory step in our credit process, whereby each and every one of our financing is evaluated for its climate and environmental performance. It's evaluated either internally for what we call dedicated purpose assets, so infra assets or real estate, for example. So the financings where we actually know what we're funding with precision, and there's another leg to the whole approach, which is what we call general purpose financing, where we have contracted out to Carbon for Finance the evaluation of our clients' climate performance. And that performance, expressed in a color rating from dark brown to dark green, has 2 consequences today. Number one is it allowed us to create pre-credit decision, what I now call an alternative perception of performance. So when a credit decision maker are evaluating a transaction, they have a color rating, and they have an internal adjusted RWA and ROE for the transaction, which is adjusted by that climate performance. That was the first phase of this whole initiative, and that first phase was what I call an acculturation phase, whereby we created the systematism of the discussion pre-credit decision, and we kind of forced that alternative perception of performance. The second phase, in which we entered about a year ago, ever since our strategic plan was announced, was to I would say, be more constraining in the approach and define targets. So now, as we speak, all the front teams have color budgets as a rare resource, if you want to call it that way, and temperature target. A comment on temperature, and I'm completely aligned with what you all said. My personal view is that it's a useful tool because it's a simple metric, and people often think they understand it, but I don't think it really matters. The accuracy of your physical evaluation on the trajectory on which you're going to be in terms of the temperature landing in 2100 versus pre-industrial times, there's no way we're going to have an accurate model for that. And the science doesn't have it, and no investors, no banks does. So the reason why we're using that temperature is for the simplicity of the exercise and for the ability to project ourselves to 2050. And what matters is the trend and the pace. So having put that in place and fully in place for now 3 years, we're now extracting data from it. And that's what we're trying to put in place right now. So that regulatory, I don't remember how you called it, but the template that was created, so called PAI, Principal Adverse Impacts, which is the template of data that needs to be provided by investors on their environmental and social impact. We're trying to answer to those data, and we've been able now from our on our dedicated purpose transactions, for example, to extract data, making it possible to address all the climate elements of the PAI. And that means that whenever we're going to be presenting a loan or an investment to private debt funds, we will be producing that data immediately and systematically. And that is really, I think, what I would call it today a bit of a commercial edge, because we have that history that very little of our peers have on the systematism of it. But very quickly, it will just be a must-have to be able to co-lend or distribute the deals we're originating.
Thank you,
Thank
Christina.
you very much. Thank you. I think we can give a great applause to them also. Thank you. I know you have some challenges to come, Orit Azoulay. So we have a couple of questions. Do you still have 2 minutes, or because we have one question for you? Could you give us an example of operating process implemented to reach 2.5 degrees target?
There are plenty. Yes. Well, the targets I mentioned is the number one of the operational process. I'd say the second, I still call it operational, is the fact that those targets have now penetrated all the HR incentives for all teams, front teams. And I can assure you this has a very great impact. And otherwise, I mean, we're now systematically embedded in our client tiering, in our business reviews, in the work we do with the portfolio, in terms of evaluating the single impact, the impact of a single deal on our temperature trajectory in a systematic fashion. So I could name many of those, but it's proving to be quite transformative, I have to say.
Thank you. One last question. We're running a little bit out of time. Maybe we have, depends on the answer. The EU taxonomy focuses on environmental factors, although sustainable investment strategies and policies consider often social ones as well. Do you give, this is a question obviously for investors, do you give equal weight to social factors versus environmental ones in your investment policies? And which are the social benchmarks that you consider most important? Who would like to take the question first?
Yeah, I can answer this one. Yes, of course, when we're considering ESG due diligence on investment, social factors are really important. We cannot say that we weighted them less than environmental one, of course. When we consider our fund dedicated to infrastructure and energy transition is maybe a little less relevant when you consider SME investment. Of course it is. However, define benchmark is difficult or key metrics is difficult. It depends really on each underlying business. You know, if you are in the car manufacturing business, if you are in IT consulting or whatever, it really depends. So I would say that to answer your question, yes, it's really important. And benchmark really depends on the underlying business.
You want to add something? And Henri Désolé, thank you very much. You have to travel. We know about that. Thank you. Thank you again. Yes, please.
Yes, for real estate, social is very important because we spend more than 70% of our time in buildings. So in our ESG grid, the social pillar, the same weighting as the environmental pillar, and it includes soft mobility, health, well-being, services inside the building, and accessibility, for example.
Thank you.
And if I can add one thing is at Tikeo we work a lot through ESG ratchets. Okay, so our expertise basically is to go look at the company and try to identify what are its weaknesses in terms of environmental, social aspects. So it will depend on the company and its industry. But we do not value more environmental aspect than social. It will really depend on what kind of industry we are facing, what is the maturity of the management in terms of environmental or social aspects, and if there is nothing to work on, we will not work either on environmental or social. So it's very different from one industry to another.
Well, thank you very much to all of you. Thank you. Great applause.